The warning signs are flashing red everywhere. The US dollar, the currency that has dominated global finance for decades, is experiencing one of its sharpest declines in recent history. Major financial institutions are sounding alarms. The banking sector is showing cracks, and economists around the world are asking the same question. Is this the beginning of something much bigger? But what really matters is how this affects you, your savings, your investments, your family's financial future. That's exactly what we're going to break down today, step by step, so you can make informed decisions to protect what you've worked so hard to build. Understanding the dollar's decline. When we say the dollar is falling, we're talking about its value compared to other major currencies like the euro, the British pound, and the Japanese yen. This is measured by the US dollar index, which has dropped sharply in recent weeks and is now near its lowest level since early 2022. The numbers are striking. The dollar has lost around 2.5% in just 1 week. Over the past year, the decline is more than 10%. For a global reserve currency that underpins the world's financial system, these moves are significant and have sent shockwaves through international markets. 3 major factors are driving this decline. First is political messaging. When leadership publicly signals that they're not concerned about a weaker dollar, or even suggest it could be beneficial, markets react. Investors take this as a message that defending dollar strength isn't a top priority. Currency markets are extremely sensitive to these signals. Second is shifting trade policy. New tariffs and changing trade relationships have increased uncertainty in global commerce. When businesses and investors can't predict trade flows, currency volatility rises. Companies that rely on imports and exports are being forced to adjust, and that uncertainty feeds directly into currency markets. Third, and most importantly, global confidence is shifting. For decades, the dollar's role as the world's reserve currency seemed unchallenged. That confidence is now being tested. Central banks around the world are actively diversifying their reserves to reduce reliance on the dollar. The banking system under pressure. Now let's look at what's happening inside the US banking system, because this is where concerns deepen. American banks are currently sitting on roughly $337 billion in unrealized losses on their investment securities. In simple terms, banks bought bonds when interest rates were low. As rates rose to fight inflation, the market value of those bonds dropped. These losses are on paper unless banks are forced to sell, but they still matter because they weaken banks' ability to handle stress. We saw this exact problem in 2023 with Silicon Valley Bank and other regional failures. When depositors panicked and withdrew funds, banks had to sell assets at a loss, turning paper losses into real ones. That fear spread quickly. Today's banking system is stronger than in 2008. Regulations are tighter and capital levels are higher. But the combination of a falling dollar, large unrealized losses, and policy uncertainty has markets watching banks very closely. Any sign of deposit flight could reignite stress. Why gold and silver are surging. As the dollar weakens, precious metals are surging. Gold has reached record highs. Silver prices have jumped sharply. This isn't random. First, gold and silver are priced in dollars. When the dollar weakens, these metals become cheaper for buyers using other currencies, increasing global demand and pushing prices higher. Second, precious metals have served as stores of value for thousands of years. When confidence in paper currency declines, investors naturally turn to assets that don't rely on government promises or central bank policies. Third, central banks themselves are buying. Many countries are increasing gold reserves to hedge against dollar risk. When institutions managing national wealth move away from the dollar, markets take notice. This surge reflects real concern about currency stability and a desire to protect purchasing power. How this affects your daily life. Now let's talk about what this means for you. First, prices. A weaker dollar makes imports more expensive. Over time, this shows up in higher prices for electronics, vehicles, clothing, and certain foods. This quietly fuels inflation and reduces your purchasing power. Second, savings. If your money is sitting in low-interest accounts, inflation slowly eats away at its real value. You may have the same number of dollars, but those dollars buy less. This is especially dangerous for people on fixed incomes or nearing retirement. Third, investments. Currency volatility affects stocks, bonds, and real estate. If you rely on investment growth for long-term goals, added instability introduces more risk into your planning. Fourth, debt. Variable rate loans can become more expensive as conditions tighten. Even fixed-rate debt becomes harder to manage if inflation reduces real income while payments stay the same. Practical steps you can take now. This isn't about panic, it's about preparation. Step 1 is awareness. Understand where your money is, how much is in cash, investments, debt. You can't make smart decisions without clarity. Step 2 is diversification. Don't keep everything in one place. Cash, stocks, bonds, and real assets each play a role. Diversification reduces risk. Step 3 is considering precious metals carefully. Gold and silver are hedges, not miracle solutions. Many professionals suggest 5 to 10% exposure, not more. Gold tends to be stable, silver more volatile. Physical ownership offers security, but requires storage. ETFs offer convenience without possession. Each has trade-offs. Step 4 is debt management. Know which loans have variable rates. Rising inflation can increase costs. Refinancing into fixed rates may reduce surprises. Step 5 is an emergency fund. 3 to 6 months of essential expenses in liquid cash protects you from being forced into bad decisions during stress. Step 6 is income review. Workers should assess job security and earning potential. Retirees should understand whether income sources adjust for inflation. Income stability determines how much risk you can take. No one can predict the dollar's future with certainty. This could be temporary, or it could signal a longer shift. What's clear is that uncertainty is rising. Those who fare best aren't the ones who predict perfectly, but those who prepare. Preparation doesn't mean extreme moves, it means balance, diversification, and resilience. The US still has major strengths. This isn't a guaranteed collapse, but assumptions about permanent dollar dominance are being tested. The dollar's decline is a warning signal. What happens next is uncertain. What you can control is how prepared you are. The best time to act isn't after a crisis, it's now. Take these signals seriously. Stay calm. Make informed decisions. That's how you protect what matters most.